What's up, you guys? Welcome back to the channel. If you're new here, I would thoroughly appreciate it if you go ahead and hit the subscribe button. This is a brand new channel. We're trying to grow, and every subscriber always counts, especially now. So if you haven't already, definitely consider subscribing to the channel, and also hit the like button. I really would appreciate that, you guys. In today's video, I want to ask you guys, are you prepared? And I'm not talking about, are you prepared in terms of, do you have enough food in your pantry to survive, a month or 2 months, 3 months, 6 months. We're not going to talk about that type of preparation today, although that is very important. I feel like a lot of people focus on one or two segments of survival, and I want to hit as many facets as I can. I'm certainly not perfect, and I'm always looking to improve. But as I discover new things, I want to share them with my community and help others to prepare themselves as well as their families. And there's a lot of fear in the market right now. There's a lot of panic spreading regarding what is the Fed doing with interest rates. There's a lot of fear regarding what is the Fed's raising of interest rates. We're expecting, what, 6 more rate hikes this year? How's that going to impact the global economy? Well, in more particular, let's focus it down a little bit. Excuse me, how is this going to affect the U.S. economy? Now, I have witnessed one house go up in my neighborhood recently, and it got me and my wife talking, and we were talking about, whether or not we think that this person is going to be able to get what they're asking for the house. And obviously, with the hike in interest rates, we can't pretend like this is just not going to slow anything down. There's going to be some kind of an effect on the housing market from a real estate perspective. Now, I also got a letter that I want to talk to you guys about. So I have a lot to unpack in this video today. Many people are asking, what's going to happen with the housing market? What's going to happen with the global economy with the raising of interest rates? How is that going to affect everything? Jobs, the rate of hiring, inflation. The main reason for the Fed increasing interest rates is to combat inflation. Inflation's at an all-time high. I don't know if it's at an all-time high, but we are bordering on the hyperinflation side of things. And so, many economists, investors, and people who are just like me and you, just trying to prepare for whatever comes our way, we see inflation right in our faces. And, it's showing up in gas prices, because even before the Russia-Ukraine war, let's be honest, we were seeing gas prices starting to hike up anyway. So it only hyperinflated the rate that gas prices were going up once the war took place and actually, kind of became a real thing. Sanctions being implicated on Russia, that certainly exacerbated the prices of certain foods, wheat, gas, obviously. The price of oil shot through the roof. So one thing we have to understand is we as survivalists, if you want to call yourself a survivalist, but if you're human, you're a survivalist. It's like our whole goal in existence is to survive in this world, right? So, but not only do we want to survive, I would hope that you want to thrive. So the big question is, with what is going on right now in the world, is now the right time to buy a house? Should you buy a home in this real estate market right now? Should you sell your house in this real estate market right now? What is the direction of the housing market for 2022? These are questions that a lot of people have been asking themselves, and I've read the opinions of many acclaimed economists, and I would certainly say that I see a variety of responses in terms of whether or not the housing market is going to crash going into 22 or 2022. Will the housing market crash going into 2023? Well, I first feel like, you know, we have to take a quick step back and look at history. How did the 2008 housing crash occur previously? And will we see a replay of that going into 2022, 2023? I'm hearing alarms and sirens going on right now. Man, yeah, the emergency vehicles were going by, so I apologize for that. But anyway, apparently they don't know I'm recording. So anyway, are we going to see a housing crash? And what should you do about it? What should you do to prepare? I may have to break this video up into a couple of parts because there's a lot of components to this here. But, you know, I had some things on my mind, and I just want to share with you guys. You know, we talk about preparation from a food standpoint, but let's also, you know, talk about preparation from a financial standpoint. You know, like we can't ignore these things, and we don't want to be caught off guard. So, obviously, without finances, you can't go to the grocery store and purchase food. So our financial house needs to be in order. We need to be able to make our mortgage payments, our rent payments, whatever your situation is. Now, whether you're a renter or a homeowner, the Federal Reserve's raising of interest rates is going to affect everyone. Okay? So, house went up in the neighborhood recently, and me and my wife deliberated over whether or not they're going to get their asking price. And in this housing market, it's really interesting. You got buyers and sellers. On the one hand, the buyers are like, okay, some buyers are probably going to say, you know what, I need to hurry up and buy a house before these mortgage rates go up any higher. I just talked to a buddy of mine, and he said that the interest rate he was quoted was 4.3%. Now, we refinanced our house, we purchased the house 7 months ago. So we purchased the house 7 months ago, and we got an interest rate of 2.8, something like that, 2.7 or 2.8, I forget. Whatever the case is, that was the rate we got 7 months ago. Today, he got quoted 4.3%, and I'm seeing more and more 4%, 4.2, 4.3% interest rates for mortgages. And so, obviously, that's going to affect how much your mortgage payment's going to be. It's also going to affect how much you're going to be spending on that mortgage over the life of the 30-year or 15-year mortgage, or whatever the term of the mortgage is that you choose. And the housing market, depending upon where you live, is up 20%, 30%, 40% over the past, 2 years. And what was very interesting is that most people, if you asked them going into the pandemic in 2020, March, April-ish, many people were thinking and anticipating a housing market crash. And that crash was very, very temporary. That crash, it was a little bit of a decline in sales price for about a month or two, if you ask me. At least in my area. That's why I say if you ask me, because real estate's local, so maybe your area didn't see it, but in my area, we saw real estate prices dip a little bit for about 2 months, and then it quickly recovered and began to take off. So conventional wisdom, you know, most people felt like, hey, the housing market is for sure going to crash. And it turned out to be one of the most remarkable boom housing appreciation periods in our lifetimes. I'm not aware of any historical period in time that had housing prices appreciate at the rate that they did over the last 2 years. Even if you took 2007, 2008, let's just say 04 to 2008, housing prices didn't grow at the increase at the rate that they did these past 2 years. So the first thing you have to look at is, Were we even in the, like, it's interesting. In both periods, housing prices increased, but the reasons why they increased were different. So just because you have a aggressive increase in housing prices, it doesn't mean that you're going to necessarily have a crash. Now, most markets are fairly elastic. So if there's a crash, then there's a pullback, or if there's a crash, then there's a rebound, typically, right? If there's a bubble, then there's a pop. So it's like a rubber band. Economies generally expand and then they contract, and it's just a cyclical thing that happens. But what happened in 07, 2008, when the bubble did burst in the housing market, it was different then, right? Like then, houses were appreciating because of a number of circumstances that don't exist in large capacity now. Housing prices back then were appreciating because you could get a mortgage back then with very minimal mortgage approval criteria. You didn't need a down payment. You didn't need super strong credit history. You didn't even need to prove your income. You could get stated income loans back then. Today, it's not the same. Today, they're verifying everything. The lending practices are not at all the same as they were back then. So first of all, back then you had an influx of people who were just unqualified to buy houses. And when the market did burst and interest rates adjusted, because that was the other thing, many people were getting into houses with minimal credit worthiness, no down payments, and they were getting interest only loans or adjustable mortgage loans. And so when these interest only loans and adjustable interest loans were adjusting, when the interest rates went up, their mortgage payments went up, and these people were barely able to afford where they were living anyway. So again, these unqualified buyers found themselves in a pinch, and there was no equity in these houses. They didn't put anything down, and many people just got burned when the tides changed and the interest rates shifted upward on them, causing their monthly payments to go up. There was a wave of unemployment going on at the time, right? So high unemployment, tons of unqualified buyers getting into houses. There was, let's not even talk about the inventory. The inventory was, there was like 2 years of excess inventory on the market at the time. So, and then one other key factor back then was you had a slew of real estate fraud going on, where appraisals were coming in way above what the actual values of the houses were. Many appraisers were in cahoots with the real estate agents, and the real estate agents were in cahoots with the mortgage brokers and so forth. So there were these falsified appraisals to support the values of these homes, to get these overpriced homes to sell and actually get a mortgage on them. Home builders were tied into it. It was a huge mess, and a lot of that just eventually the card house fell. Today we don't have, I don't even remember the last time I saw a stated income loan. So as far as I'm concerned, those don't even exist anymore, and if they do, they're a very, very small minority of loans, and certainly not in any kind of mass capacity. We don't have massive unemployment right now. In fact, many employers are struggling to find employees, and this is why employee raises are going so high so fast, which is also impacting inflation. So that's another mess. But we don't have the massive unemployment issues today. Granted, we had a lot of unemployment going into the pandemic. We did have that. However, we don't have that today. And we also didn't have the amount of unemployment support from the government to the extent that we had in the past 2 years. We didn't have that back in 2008. So those are some stark differences. Many people were, making equal to or more in some cases being unemployed than they were working. So unemployment, yes, there were periods of high, both periods had high unemployment, but the unemployment, the response to unemployment being very high from the federal government was totally different this time around than it was then. The other thing is that we have so many more people working from home today than we had back then. So with more people working from home, remote work opportunities, you have more people able to live in the suburbs if they choose to. They're not forced to have to work nearby their job, which may happen to be in the city, just for, because a lot of people, they don't necessarily live where they want to live. A lot of people live close to work because they don't want to have an hour or 2 hour commute. But when you have the option to live where you want to live, you can choose where you want to live. Many people have decided, who have families, they want to live in the suburbs. So that kind of drove up the demand for suburbs. And of course, with the whole pandemic, social distancing and isolating yourselves from people, you needed that space, and you certainly wanted it. Many people are preparing for whatever might happen. We saw empty shelf situations that we had never seen in the grocery stores. It was ridiculous. And many people said, hey, I need more space. I need more pantry space. I need more space to place my deep freezers for, additional storage for meats and other items you want to just kind of freeze. Also, spending more time at home, you wanted more space, right? I mean, if you're going to be locked down, you didn't want to be locked down in an apartment. If you could choose to be locked down in, say, a large house with a nice big backyard. So that certainly drove up the demand for residential properties. And then, of course, if you look at the two different time periods, there was excess inventory of housing. We don't have excess inventory of housing right now. In fact, there's a low inventory situation with housing in our housing market right now. So the situations were very, very similar in terms of home values elevating in a short period of time, but at the same time, the circumstances which allowed the home prices to go up in price, to go up in value so quickly, they're not the same today. Now, we do have, well, let me go back. So, all right, so we covered unemployment, home prices, why they went up. Today they went up because there's a lack of inventory and everybody and their mom was trying to get out of an apartment and get a house. Also, let's not forget, interest rates were dropped. The Fed lowered interest rates to kind of to attempt to stave off a recession. So that encouraged tons of people to refinance their houses. Now they want to stay, right? I refinanced my previous house in 2020. That encouraged that, so it caused people to refinance their houses to get a lower interest rate. Now their mortgage payment's lower. Also, that encouraged people to want to go and buy a house because now you could go buy a house for less than you could before. It boosted your buying power. So that just really just enticed a lot of people to run out and buy a house. But as everyone was running out to buy a house, they weren't building houses at the rate that they were because there was a big lockdown and there was a supply shortage of materials. So it's like, it was almost a perfect storm to drive up home prices because everyone and their mom wanted a new house at this point. Hey, everything, your monthly payment was less than what it would have been previously because the interest rate, which largely dictates how much your mortgage payment is going to be, it dropped. So your mortgage payment was lower. So wow, I can finally afford a house, or, and I can get out of this small apartment. So that happened. All right, so interest rates went down. Oh, and then you have way more qualified buyers now. There's none of this stated income loan crap that they had back then. I swear, I'm a qualified buyer, and they grilled me to make sure that I was putting down a legitimate down payment, validated where my down payment funds were coming from, validated like 5 years of employment, credit history, credit check, blah, 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 you name it. They asked about certain transactions within, you know, within my bank account history. Like, they were digging. These underwriters, they're making sure that they're giving these loans to qualified people. And, you know, if someone were to lose their house due to foreclosure, it's a whole lot more painful to lose a house in foreclosure when you've got equity to lose versus, say, back in 2008 when the housing market crashed and people walked away from houses because they didn't put any money down. If you put $100,000 down on your house, you're going to fight tooth and nail to keep that thing, versus, you know, someone who put nothing down. I don't think that they're going to give up the same level of fight. So the situations are absolutely different. Do we have a housing market crash in 2022 going into 2023? I don't know, but I know that the situation is different. Material shortages are still real. I do see new housing coming on the market, not super fast, but I do see it. But I will say this, there is a limit to how much Americans can spend on housing. And with interest rates going up at the rate that I expect them to go, federal interest rate, you know, Jerome Powell saying that we should be expecting, what, 6-7 more interest rate hikes this year. If we went from, say, 2.8% interest rate availability for a 30-year fixed mortgage back, what, 7 months ago, and today interest rates are somewhere around 4.2%, what, 4.3%? That's a huge gap. That's a huge difference. So I don't have a calculator with me, but let's just say that, you know, a $500,000 house in a $500,000 house 7 months ago at 2.8% might have cost you, it depends on your down payment, but let's just say it cost you, for a 30-year mortgage, it cost you, I don't know, $3,000. Let's just say it's about $3,000 a month. Today, that same $500,000 house at 4.3% is probably going to cost you more like $3,400, maybe $3,500 a month. So that is a $400 to $500 difference in your mortgage payment on a $500,000 house. Now, let's just say, you know, housing prices are different across, you know, different regions of the nation, not to mention within your city. So let's just say $250,000 house. And those are so hard to find now, right? So a $250,000 house might see maybe a $250 increase in the monthly payment. So just to give you some perspective on how much that interest rate change would have on the mortgage payment. Now, most people, not everyone, but most people, when they're looking to buy a house, they're looking to buy a house and they're deciding if they can afford it based on the mortgage payment. And even if they want the house, if they can't get qualified because their income doesn't support this higher mortgage payment, they can't get the house. So, you know, with the housing market being up 20 to 40%, depending upon where you live and depending upon what housing market you're looking at, that's already a massive increase in the prices of real estate. Now, when you factor in increased mortgage rates, my question is, you know, even if the buying frenzy, the panic of, you know, fear of missing out on the house remained high, there is a limit to how many people will be able to continue to chase after these ever increasing home values. I think that what keeps home prices high and staves off a crash would be if supply of materials remains low and new houses can't come on the market faster than the demand and purchasing of existing homes that are on the market. So meaning, like, if construction picks up and adds more and more houses to the market, and new houses into the market faster than they're being purchased, that's gonna increase supply. That'll add pressure and weaknesses on price. So I'm gonna be looking real close. A lot of people are like, hey, should I buy a house today? Should I sell a house today? It depends, but here's some factors I want to look at. I'm going to be looking at how fast is new construction coming on the market, how fast are existing homes coming on the market. But here's another factor. If an existing home comes on the market, you got to wonder, what are the reasons behind why people are selling? Because if people are selling because they want to move to another place, well, that's one house coming on the market for sale, right? But then that's another house that will come off the market when they buy. So it's very interesting to watch the market and see, because our economy is so intertwined. It's never one thing. There's never one event or one crisis that will force something to happen. It's like throwing a rock into a still lake, right? You throw a rock in and you're like, all right, I'm gonna throw the rock in and it's gonna hit the water, but it creates these ripples, and it creates all these unintended consequences that you almost can't predict everything from a single event. And then you have the human nature effect of it, right? Everyone's going to respond in their own way to the stimulus, which would be, and I don't mean stimulus like stimulus checks, but a change in the environment, right? So when an interest rate change happens, people are going to look at it different ways. Some people may say, oh man, interest rates just went up 1%, or interest rates went up like 0.25%. I need to hurry up and buy a house before they go up any higher. But then someone else may look at that same interest rate hike and say, hey, interest rates went up 0.25%. Well, I don't want to buy now because they used to be this, right? And so it's not they might not see it as much of a deal. So now they're coming off the market. But then other people may say, well, I need to hurry up and buy. And here comes more flood in demand for purchasing of new houses because, fear of higher prices in the future. So anyway, I have this here, and I wanted to just kind of share it with you guys. This is a annual escrow account disclosure statement. It says each year the mortgage company reviews your escrow account to determine your new monthly escrow payment. As you may know, we collect funds and hold them in your escrow account to pay your property taxes, flood insurance if required, homeowners insurance premiums, leasehold payment if applicable, and mortgage insurance premiums on your behalf. Below are answers to the most commonly asked questions we receive about the annual escrow analysis and details related to your account. Now, what this is telling me in a nutshell is that your mortgage payment is going up. My mortgage payment is going up, and guess what? I'm not the only one getting one of these letters. My mortgage payment, and a lot of people look at houses naively thinking, oh, I'm going to buy a house. It's a great investment. Annual appreciation. I get to write off property taxes. I get to write off interest, mortgage interest, and so forth. And, I'm locking in how much I'm paying for my house. I would rather buy a house instead of renting because at least, when you buy a house, your payment's X, and I don't have to deal with any more rent increases. Well, some of that's true and some of that's just completely false. And here's proof of it. Granted, your mortgage payment, technically, it doesn't go up, but technically it does. And the reason being, and I'm talking about if you have a fixed rate mortgage, here's why it goes up. It goes up because if you're escrowing your property taxes and your property insurance, well, when those rates change, your homeowner's insurance doesn't stay the same year after year. It changes, and generally it goes up. Property taxes. Well, hey, when properties increase in value, the county you live in is like, hey, your property's worth more. We're going to reassess your house, and now your property taxes went up, right? And they generally don't go down as much if the market corrects, right? So anyway, here, thankfully they didn't reassess my house, saying that the value went up, but I'm pretty sure they're going to do it in maybe 6 months or a year, because housing prices and values did go up. But what they're saying is the mortgage payment's going up because there was an increase in the hazard insurance on the property. So guess what? My mortgage payment just went up by $106.05 every month. That is roughly $1,200 a year more that I get to spend on living in the same house that I've been living in. So how many people are going to be ready for when their homeowners insurance premiums go up, or when their property taxes go up because their home values went up, right? Now, is there a housing market going to crash? Is the housing market going to crash with the expected events that are occurring and going to occur? Well, here's the thing. If you didn't buy a house, you're going to rent a house. If you didn't buy a house, you're going to rent an apartment. You're going to rent somewhere. I would say that if you wanted to buy a house, will the housing demand go down because interest rates are going up? Well, it could go down because fewer and fewer people, as interest rates go up, are going to be able to afford the same price point. Because, as we said, that same $500,000 house is getting more and more expensive on a monthly basis if your interest rate's going up. So at some point in time, the mortgage company is going to say, hey, your debt to income ratio is going to be too high to approve you for this mortgage. We can't let you buy this house. 6 months ago, you could have, though, before interest rates went up. So that'll happen. But then those same people who wanted to buy will have to A, renew their loan or renew their rent or their lease from wherever they're renting, or they're going to have to, start renting if they're not renting already. Or if they already have a house, they're gonna have to stay in their house, which would mean that that house that they're staying in, that they plan to sell because they were trying to get a new house, hypothetically, that house will not go on the market because they can't afford to move into a different house. So I would say, even though many economists, I would say 75% of the economists I've been following are saying that the housing market's probably going to be going down, I do agree that there's more downward pressure on housing prices, but I don't think that there will be a housing market crash. I'm not the guy who predicts the future events. I'm not that guy, but I think that housing demand is real, but the Fed's interest rate hikes are definitely going to affect buyers' ability to pay the current prices, and raising prices in the face of increasing interest rates will almost double the difficulty to be able to buy a new house. So more and more people will not be able to qualify. That's what I predict. It's just mathematical. It makes mathematical sense. And I feel like the upper end of the housing market, the upper end of real estate, so the more expensive houses in the area, are going to be affected first, because there's always fewer people who can afford more expensive homes than there are people who can afford less expensive homes. Of course, there are generally fewer more expensive homes than there are less expensive homes, so there's that dynamic. But I do feel like, the price sensitivity will affect the upper end of the housing market first, before it affects the lower end. But those are my thoughts. I'm going to talk more about this in a future video, but I just wanted to kind of just jump on here, hopefully just kind of share some thoughts that I had on the future of the housing market. I want you guys to be prepared for what's coming. This is coming. This is coming. Increased mortgage payments, even if you already have a house, are coming. And if you're not prepared for it, I want you guys to be prepared now, because not everyone's getting these letters at the same time. So again, if you made it this far in the video, I appreciate you guys hanging out with me. Comment below if this is insightful information. Comment below if this is something that you hadn't thought about before, if you have thought about before. And also, lastly, let me know if you think the housing market is going to crash or not. If you haven't already, do subscribe to the channel. Also, drop me a like. I appreciate that, you guys, and I'll see you guys on the next one. Take care.